the system is bombarded with liquidity, and money and all, that will also still not spook the market or bring the market or the animal spirit which is required in the market, or it is like it is worse than maybe COVID.
If the war stops, maybe the initial jump up will not be supported by foreign money, but ultimately that money will trickle in and start supporting the markets.
Investors in general are jittery. I mean, right now, I mean, this happens every time, because we feel that the world is going to end. Good evening, partners, and thank you very much once again for joining us for the another episode of Market Pe Charcha. Markets will always go through these turbulent times and go through the volatility, but what remains constant always is the opportunity which lies ahead. And to assess that, and to dwell deep on that, I have with me our MD and CEO Dinshaw Irani, and today we will be doing slightly different in terms of understanding that we've been talking uh, about the opportunities which is there in the market, Dinshaw. But in fact, there is almost a 10% correction. There is FII, selling, and there is global uncertainty, right? So the question is now, to begin with, is very simple that, is it a pause or is it like going to go more deeper from here?
Okay, so let me start. By the way, thank you, Devi, for hosting this, and thank you all the participants for being on the call. So basically, this uncertainty, if you will, I mean, is war. Nothing can be more uncertain than war. At least we can take a call on certain events, but this event is a total all over the place. I'm sure even when America and Israel attacked Iran, they were hoping that it'll be a very small war. It's already continued for 20 over days, 20 more than 20 days. So obviously it stretched a long time. And the longer it stretches, the more pain it causes, right? Not only in terms of the countries who are directly involved, but also in the form of the countries which are not involved in, but are totally dependent on crude as such as an import item. So, and frankly, I mean, this couldn't have come at the worst time. If this war hadn't been there, we would have been continuing our merry pace that we saw in the month of Feb. It was a decent growth. We are probably the fourth or third or fourth best performing market in the EM space in that particular month. But unfortunately, the war brought a total stop to our pace and in fact turned us around on our heels as such. Negative flows, a lot of selling, again, markets going down and stuff like that. Yeah. Now, if the war wasn't there, obviously, as I said, that we would be on a merry pace. Now, the problem with India is, I mean, as in why we were hammered down so badly, and why, by the way, let me start off by why Feb was looking so good initially before it took a tank. The fact was that the deal was done with the US on tariffs at 18%, which was a far better deal than any other country could have got. China 30% was a disadvantage. Obviously, the Supreme Court ruling, which overturned that deal structure, brought in a 10 to 15% tariff on all countries. So that was a slight of a hiccup, but still, the fact was that now no country would have challenged Mr. Donald Trump on this 18%. I'm sure we would have gone ahead and signed that deal. However, the problem was the war which came about. Right? By the way, so by then, even the December numbers were out. Now, I don't know how many of you guys remember when I had said that the September numbers were very exciting. December was looking good at that point in time. And in fact, it's become better also as you go. So in September, quarter numbers, September of 25 numbers, the overall growth in earnings was 15% for NSE 500. But then that December number, which came about, showed a growth of 18% of our NSE 500. The small cap universe, which we are very excited about, in September showed a growth of 37%. In December quarter, the growth was 29%. Again, very exciting numbers, right? Now you compare that to the large cap universe. In September, large cap universe showed a growth of 10%. In December, it showed a growth of 13%. So basically, just the 3% uptick, while this one was like 13% as compared to 29%. And that is what the story was. And in fact, small cap started doing well as such also. But then with the present issues, it fell off the universe. I mean, the cliff, even large caps fell off, forget the small caps. We are at our same old levels which we were in the bottom of December as such. So that's where we are. Now, why did this impact us so much? The war, though we don't have anything to do with the war, is basically because we are totally dependent on import of crude, international imports of crude, right? We consume roughly around 5.5 million barrels a day, of which we import around 5 million barrels a day. Now, 5 million barrels a day, if you end up paying, say, even $50 extra. So, average used to be 60 odd dollars. And I'm being conservative when I say $50 because the price hit 115, came back to 103, 104 now. So, let's assume $50. If you're talking about $50 extra money being paid on a daily basis per barrel, you're talking about a hit of $250 million a day. If you extend that to 10 days, it's already 20 days. So basically, now you're talking about $5 billion of hit till date. Yeah. If you extend that to another, say, 10 more days, you're talking about $7.5 billion. $7.5 billion will be roughly around 17, 18 bips of our GDP, right? At 4.1 odd trillion dollars, it's around 15, 17, 18 bips. Now, you can imagine if this continues for 10 months, we're talking about a 2% hit to the GDP, right? So that's big numbers because your growth rates, and these are real term, I mean, these are not normal numbers that we're talking about. These are real numbers that we're talking about. These are all dollar to dollar impacts, right? Now, you can imagine if that continues for 10 months, God forbid it's a year or whatever. I mean, I'm not taking a call here. You're talking about 2% hit on GDP when the growth rate is expected to be around 4.5%, 5% in real terms, right? So that's where the problem arises. Half your growth rate goes away towards funding this. Yeah. Our feel is that a month of turmoil can be handled. I mean, this basically because we have reserves of around 10, 15 days, and then probably another 15, 20 days, we can manage this as such. And if that happens, I don't think India has a problem at all. The war stops, the day the war stops, things will come back on even keel for us. And it'll be pretty sharp because till now, there's not been a demand destruction. There's not been any destruction in the supply chains. It has started, but it's not there. So for this to happen, in fact, I was looking at one of the global analyst reports. He says if the war lasts out for from that time onwards, which was like day before yesterday or something, another 4 weeks, there'll be a global impact on supply chains, on disruptions in
And
crude
on the
and stuff like
GDP.
that. Yeah. So basically, our call today is that hopefully, and as I said, that's all uncertainty, right? We've been saying that this war seems to be tapering down. Uh, Israel, it did taper down, okay? But Israel went and blew up the biggest gas field in the world, which was lying in Iran, rather, not the biggest, the second biggest. By the way, Iran and Qatar share the same gas field. It's the same base, the border is common. So it's the same gas field. So Iran and Qatar together have roughly around 40% of the world reserves of gas lying out there in that particular field. So that was blown up. Iran retaliated by blowing up Qatar's gas field. And as a result, 17, 18% of the world gas supply is now off a line for the next 3 to 5 years. That's what we've been told as such. So you can imagine how impactful this could be. One more thing, the Straits of Hormuz. See, Iran alone doesn't control any crude, right? I mean, it has some 2, 3 million barrels that it used to produce earlier before the war started. But the bigger issue is the Strait of Hormuz, which is roughly around where the 7% of global energy flows from. India's dependence is almost 40% on the Strait of Hormuz supplies. China's is 80%, by the way. It's much more impacted than India is. So that's how this is. So this is very intricate that one, the strait opens up, two, the war cools off, and obviously things will come back. As I said, and you can make out also because the moment there's announcement, by the today's rally in the morning was driven by one statement from Benjamin Netanyahu that the war will not last too long, right? And that's what saw the global rally, not only in India, but there was a global rally happening. So that's what happened here. So that's where I'll stop, and I'll probably Let you ask me.
So the
So
thing
basically,
is
one
that.
more. Sorry, Devi, one thing. You asked me uh, whether it's a pause button being pressed today. So the fact is that's a pause if the war is short, but obviously if the war prolongs, the pain also prolongs along with it. Our feel is that within the next, maybe we have a breather of another 3 4 weeks and nothing beyond that, and the war has to pause before that, and things will continue on its merry pace after that.
So Dinshaw, taking that a bit forward, let's say, if you go the first decade of this, like 2007, when, that time also there was a crude related crisis. In fact, the guesstimates were there that it will go to $200 and so on per barrel. But, from there till now, I mean, the consumption of crude, which was then and today has been substantially lower, right? Uh, so do you think that that's the single largest factor, or and on the point of this deepening, and then as you mentioned that if it prolongs, then it might have. So most of these cycles we have seen when, like, instance of COVID also, we have seen that there was no visibility of even human life then, right? But then the liquidity actually. So do you think that even if liquidity, the system is bombarded with liquidity, on money and all, that will also still not spook the market, or bring the market, or the animal spirit which is required in the market, or it is like, it is worse than, maybe COVID.
So, okay, a couple of parts to that particular statement that you made, few questions which came up there. One, in 2007, the crisis that one saw, the crude touching $150 a barrel and stuff like
Mhm.
that, was mainly brought on by supply constraints, right? Demand picked up, there was not enough supply to come in a big way, and that's where the problem arose. Out here, we're talking about actual disconnect between supply and demand. Demand has remained quite buoyant, but supply has got impacted because of exogenous crisis, right? There's no repair to that. There's uh, uh, Iran constantly bombing the neighbors who are big suppliers of fuel. I think basically Iran is playing a game where it says that, look, I can't win the war with US or Israel. I can, however, win the war economically, right? Because that's where the pain point is. For US, a pain point is high crude. For Israel, it's high crude. So he's very clear that, look, if I can keep the prices higher in crude for a while by doing all these messy stuff, obviously things will cool off from their side. They don't want the long war to be long, and I think that's the game that they're playing as such. So that may work out, may not work out for Iran. I don't know, but the fact is, it's creating a lot of problems globally, and that is why the supply of crude has remained off. If the prices, by the way, so with high prices of crude, India is the least of the worries, right? India's whatever 5 million barrels of imports. I think China is around 15 million barrels of imports on a daily basis. So they are more impacted than us. We are. The biggest beneficiary, obviously, is Russia because they are now able to sell the crude on market price basis, and obviously, the Ural crude, which used to quote at some 60 odd dollars a barrel, now today is at around $100 a barrel. So it's gone exponentially higher for them, and their cost of production is very minimal. It's like 30 odd dollars, 25 $30 that they produce the oil at. So that's fairly good for them. So the fact is that if the crude remains high, the world suffers, not only India, because crude has got multiple impacts. One is obviously the energy costs, right? That's a
Yeah.
direct impact. The second one is obviously the
The
plastics and stuff like
Yeah.
that, the raw
Yeah.
material that comes in,
And then
because
there's
the
multiple
crude
chains of transportation, logistics, and all that.
the crude chain is basically the basis of all products in this world. I mean, the laptop that we're talking from, right?
Yeah.
Or the body is made from this. The metal is formed from the energy and stuff like that. So these supply chains will start getting impacted, and then the last impact will be when the consumer starts feeling the pinch of higher energy, higher products, and stuff like that, and starts cutting back on his demand. So then it leads to demand destruction. Starts with energy prices high, goes to supply chain destruction, and then the ultimate is energy, the demand destruction. Now, this all scenarios are very bad for the world, right? So that's why nobody wants crude to be so high. I'm sure even the Saudis, who are the biggest gainers out of this as being the biggest exporters, they don't want this also happening, and that is the reason why US also doesn't want it happening. Though they are also one big exporters of crude in the world today, but still they don't want that happening. So there are these multiple things which will work out. So I don't think the liquidity is a problem right now, but obviously this contains. And by the way, coming back to the liquidity problem, you must be wondering why is gold and silver was supposed to be a big hedge for towards these uncertainties. Gold, silver both are correcting, and they're correcting very handsomely. In fact, today was the first day when I saw some pop up in gold and silver prices. But the fact is that the correction is mainly because of liquidity crisis. If the argument that was given earlier that gold and silver are now becoming uh, the bankers' choice for reserves rather than USD, right? Then obviously the gold and silver then become pro-cyclical instead of counter-cyclical. And what I mean by pro-cyclical is when uncertainty hits you and you need liquidity, you sell only gold and silver to get the liquidity in for the banks, right? So that's where the problem arises now in gold and silver. So I don't see that also going up because there's a war going on as such. So that they'll only move up when the yields move up in the US. That's the feel that we have out here as such. So I don't see liquidity to be an issue. I think it's money which is being driven out purely out of safety. You've seen how the rupee has been impacted from 90 and a half, 90.78. Today it's 93.6 or 5 or 6 and stuff like that, which is a massive drop. Most of the currencies haven't been impacted so much. And India, rightly so, because we are running on the crude front, we're running a deficit as such, and we need a lot of money for that. So that way. So I don't see that to be an issue. I see if the war stops, maybe the initial jump up will not be supported by foreign money, but ultimately that money will trickle in and start supporting the markets.
So which pocket of the markets, I mean, if you look at like volatility often creates opportunity, right? So from a 3 5 year investor's perspective, the one who want to allocate right now to equity, because you know, so what do you say? I mean, what do you recommend for them? Which pocket of the market, large, mid, small, where do they start from? Because if FIIs come back, they typically would come back from a liquid large cap space, right? But we have often seen that liquidity plus all the sentiment, it is purely sentiment positive, and it actually that sort of prolongs to mid, that gets extends to mid and small cap also, those rallies. So what do you think about that this time around? I mean, once this all settles, let's hope and pray that it settles, then what do you think?
So basically, Devi, I think the obviously the passive money that which is ETFs and stuff like that that goes towards your large caps, mainly large cap, right? There are a certain pockets of mid and small which will be also driving this, but the active money which has stopped going out. By the way, and why I'm saying that is because we run a very active FI book based out of Singapore, and we've just seen inflows happening in that book as such. We started off with a 20 million corpus in uh, November of probably 24, and today it is probably around 60, 70 odd million dollars as such. So that's done very well. We've seen inflows every month. In fact, the bulk of the inflow started from sometime in November of 25. For over a year, the fund was probably languishing, and from November of 25 onwards, one saw huge flows coming in as such. And that's it what gave us hope that things will start moving around for India in terms of the movement as such. And that's why we started our small cap fund also, because we saw that happening in even the quarter of September when small cap returns were the highest. Same happened in the quarter of December when small cap returns were the highest. So our call today is, and I tell everybody that my money goes towards small caps only. I mean, personally, as such, whenever I need to invest in my own fund, I do my only small cap fund as such. And I think that is where the focus should be. And one has seen that whenever the rally happens, it's far more sharper in case of small
And
caps
that,
because they've
yeah,
corrected the most as such.
yes.
By the way, even on the valuation front, they are probably looking more expensive than large caps because large caps quoted a P of 1920 while these guys quoted a P of 2122 or so. But the fact is that 2122 is supported by a
Strong
growth
growth.
of earnings growth of 25%. So the
Yeah,
peg is
yeah,
less than one
complex.
now for these
Yeah.
guys. While for the large cap, though the growth is the PE is the cheapest at 19, but they're supported by a minuscule growth of 11 and 12%. So the peg is almost 2x the growth as such. So that's why we are very comfortable with the small cap universe, and we believe that whichever has fallen the most will be the one which will rise the most because that's where the active money will go as such. So that way.
Okay. So I think, we have answered. There are many small cap related questions. I think, that get answered too. So another thing is that, India has always been a structural story, right? I mean, for a very long time. Do you think for a foreigner it has become a tactical story or something, Dinshaw?
So the thing is that normally
Like in the
the
entire emerging market pack, if you see, right, we have a very well diversified market, right? I mean, opportunities in our market, but off late with AI and the chip war and all that things happening, right? I mean, the chip,
we lost out.
uh, you know, uh, things have changed for us, and somewhere,
Yeah.
the outlook or the promising outlook of India is sort of becoming, uh, you know, uh, okay-ish for us, right? So your take on that?
Yeah, so basically, the thing is that we were, by the way, we keep telling ourselves that if I don't have a choice in this world, India is a very good market, is despite the fact that we apply taxes on money which comes from abroad, which no other country does. We are the only one who do it in the emerging space
Yeah.
that we are in, I think, except China, which doesn't like foreign capital anyways. So that's why more bulk of the capital flows to Hong Kong rather than China as such. But anyway, the fact is that that is not the case. There's always choices in the world, and that's why money flows to the cheapest market as such, right? India, unfortunately, has never been cheap. India has always been a very expensive market, basically because of the composition of our index. Most of the emerging market economies or like, emerging market indices, which are there in the MSCI EM index. There are 24 countries, by the way, in the MSCI EM. The bulk of them are commodity heavy markets. And as a result, as you all know, commodities is very cheap, right? It's always quotes at P's of single digit P's. But unfortunately or fortunately, whatever you want to call it, India has doesn't is not commodity. The index is not commodity heavy. We have the likes of FMCG companies, which quote at P's of 40, 50, which according to us are not justified, by the way, because the growth rate, earning growth rate there is 10 and 11% or high single to low double digit growth rates, right? So those are the kind of P's that one commands. We have a sector called pharma, which is seldom represented in any other index. Quotes at P's of 30 plus, right? We have a sector like probably IT services, which again is a very India dedicated sector, which used to earlier quote at P's of 25, 20, 30 odd, but today it's 15 to 20 P's given the onslaught of AI on this sector as such. So that's why our Ps are always very higher as compared to the three other major markets. For instance, China, which is totally commodity heavy, Ps of 11 and 12, which again is very expensive. By the way, they used to quote at Ps of 7 and 8. They've gone to 11 and 12 as such. Taiwan, again, a very semiconductor heavy market. Semiconductors globally are considered a commodity. Uh, you can't the designers of chips are the ones which earn the P's, while the manufacturer of chips are pure suppliers, and that's why they quote. And the same is the case with Korea. Again, a semiconductor heavy market, heavy industry, heavy index, and that's why they quote a low P. So India has always been expensive, but the peg has been very exciting for India, which unfortunately went away thanks to the way the policy tightening was happening, not only in the monetary but also on the fiscal front. And as a result, India lost its growth story somewhere in the beginning of 24 as such, continued to suffer well into 25, FY25. It was only from September 25 when growth came back with a vengeance. Though 15% doesn't sound that exciting, but the fact is that that is the growth rebound from low single digits to 15%. And that's what excited everybody as such. And probably they gave it another month another quarter to decide whether they want to come in. And that's when Feb, you saw some amount of trickle happening from the FII front. But unfortunately, the war came at the wrong time and took away everything from us as such. So anyway, so that's where I was coming from. And yeah, so this is how I see the thing. Where, sorry, Devi, what was the question again?
So the now which now the question now to you is that
So, okay, so
which
FII flows, FII flows. Sorry, that was the question that you had asked me on the FII flows. So basically, now the thing is that if things rebound back, by the way, this month has been very bad for us,
yeah,
March
yeah,
itself. Heavy selling happening in March.
we said
And our
yes.
feel is whatever little that we've gleaned is that it's mainly the Sovereign funds which are selling heavily in India, and mainly because Sovereign funds are normally don't take a call on the market per se. They take a call on their float and they sell whatever is sellable, right? And it's not only in India, it's happening across the region where the Soviets are selling, taking money back to their countries as such. And when I talk about Soviets, you can very well guess we're talking about mainly the Middle East Soviet funds, which are invested in various countries. They're pulling their money back in because that's the float that they're seeing as such. Yeah. Again, FY20, CY25, sorry, was a very bad year for India because CY25, the whole emerging markets, the MSCI EM rather grew at 31%. India grew only 3%. We were underperforming at 28%. And our feel was there'll be a rebound happening with the 20th, by the way, worst performing market in a group of 24 as such. In January itself, we thought things will start rebounding, but January we were the 23rd worst market in a group of 24, and the 24th was Indonesia. Indonesia is moving out of the MSCI EM index. They're being put in the frontier index, and that's why they suffered so much. India didn't deserve that kind of a hit. But then, as I said, when December numbers came, things started coming back. Deal happened, deal was signed, things started coming back. But that's how it is. So my feel is if this war stops very short, I mean, in a short while, probably you'll see another couple of months before FI start coming back in again. March quarter, the Jan Feb numbers that whatever we could glean off from the calls of after the quarterly calls, we felt that the numbers were still they were looking very good as such even then. But I don't know March what it has done. So maybe there'll be a reset. It's a postponement of demand, not a destruction of demand till now, right? But if this continues further, there'll be a destruction of demand, which will be a problem. So next quarter, if this stops pretty soon, the war, you'll see demand coming back in full flow, and that's why June will be a very good month, a very good quarter for us as such. So that way.
So I mean, you see that this impacting the estimated numbers, forward-looking numbers, and all that. You see that happening.
Yeah, there
If
will
it
be so
like
so.
like this
I don't
quarter
think.
has been pretty bad. I think this entire month has been very bad.
Yeah,
I don't
but
think.
as I said, Devi, the fact is it's all sentiment driven. Today, the sentiment has not been destroyed. I mean, I'm sure if you walk into a mall or something like
No,
that,
I'm
you'll
talking
still see.
about the on ground, like, say for example, people have been saying, and I was reading also that restaurants have in fact there are articles that restaurants have stopped cooking, and I don't feel though I wherever I go, but I read that. So do you also are you also from that front that that nay, it is happening
No, no.
on the
So
ground also?
that's why I said the gas. So basically, it's all gas. Literally, what is being talked about is all gas.
Yes.
But the fact is that I've not seen any restaurant telling me that sorry, we have run out of gas, so you can't order anything. There have been selective issues, probably, but not too deep a issue right now. In fact, the government has been very proactive in ensuring that the supply remains. We were talking to a few heads of various companies which are into refining and all that. And they were saying right now it's all about procurement. The government has given us an open mandate that procure wherever you want to procure from. In fact, today only you must have read that four ships bound for China were diverted to India because we bid a higher price for them. So this is all over the place right now, right? So that way, I don't think there's a problem. But as I said, this is all short term. If it prolongs for a longer term, it'll be a problem. And as I was saying, that I don't see a demand destruction today because when you walk into a mall or you walk into any high street, you still see crowds happening out there. You still see people going and buying out and stuff like that. So
Yeah,
that
even
hasn't impacted. That hasn't impacted us till now. But obviously, as I said, if this prolongs, there'll be a problem.
Dhurandhar
And
seems to be full.
yeah, imagine. I mean, people are going and watching
So at
4 4 hour
least
movies
coffee and popcorn's been
now.
served.
So yeah. So you can imagine what's happening out there. But anyway, the fact is that as of now, things are not bad. As I said, if this continues, I don't see the March quarter to being too bad. Obviously,
Okay.
the export-facing guys will have a more problem, bigger problem.
Yeah,
Like for
because of the
instance, if I was to
logistic.
look at my portfolio, probably Larsen is something which is totally dependent on the Gulf. Totally, as in 30 odd percent of his revenues is dependent on Gulf. So that may be impacted. That's why we're not seeing you're not seeing too much of activity in our portfolio in Larsen also as such. So that way. But anyway, I should be talking about stock specifics. This is not a recommendation to
Yeah.
buy. Please
Yeah.
understand that. Not even a recommendation to sell or whatever. But the fact is that I just talked about just to give an example of where the problem will arise if it arises. But in the domestic front, I don't see a problem. I think the March quarter will remain. But again, the caveat is if this prolongs, obviously the pain will prolong. So
So coming back to our funds, Dinshaw, because there have been a lot of questions. So, overview on that, how are we positioned now? I mean, in terms of sector calls, not the stock specifics. I do not want you to talk about stocks. And also, the volatility, which, in general, uh, there is a question on that the small cap as a segment has seen. So how are we, pegged against it?
okay, so basically we did hold a bit of cash initially. I mean, as in when the war started, we weren't investing any new money which was coming in. But off late we started doing that. We started deploying the cash that we had, and our feel is that, as I said earlier, also that small cap will be a of outlier in terms of performance whenever that comes in as such. And one has seen that also whenever the performance, I mean, whenever the markets move up, the small caps do a far better move than the large caps do as such, or the mid caps do as such. So that's why our money is there only. I mean, as in we going on investing new money. We continuing our focus on domestic driven stories. Consumption stories is a big play for us. Infra also is a big play, but only in certain pockets of infra we are comfortable with. So that's where we are today. I don't see any big issues happening. We haven't churned the portfolio at all. I mean, as in churn, as in we haven't. We did sell out a few stocks, which you'll see at the end of the month as such, whenever the fact sheet comes out, where we felt there's a problem because of whatever's happening abroad. I mean, as in the war happening, war as such. But otherwise, we've added names which are more of domestic focused, and we continue to remain pretty okay with those names as such.
So another question. So now I'm taking questions. So now there's
Yeah.
another question that one very nice question, which is that what is the three statements for investors? Because I know, and in fact I learned from my interaction with partners also that investors in general are jittery. I mean, right now, I mean, this happens every time, because we feel that the world is going to end. This happened during COVID also. I think we sailed through that and we are sitting here. But what are your three statements for investors who are like, say, for example, who invested in our small cap also? I mean, who were like, very risk heavy or risk taking investors who invested in mid cap or invested in blended, products like flexi cap, or, what are your suggestions for them?
So okay, basically the first statement is don't panic. I mean, please understand we've seen these markets for 30 years, and I think normally all the investors they panic at the bottom of the market. That's one thing that is avoidable. Please don't do that. Secondly, is do not average. Don't think that just because some stock you own has fallen so much and you need to average there. Don't do that because you may be wrong in doing that. Leave it to the professional managers. We do that. We do that on regular basis. Every time the price correction happens, we question ourselves. Did I read it wrong? Did I get the story wrong? Did I make a mistake? And stuff like that. If the answers are no to all these, that is only the time we buy. Please do not try and, uh, as they very eloquently put it, try and catch a falling knife. The momentum, please understand, is the highest next to the near the bottom of the ground as such. So stay away from the temptation of doing that. And thirdly, uh, continue to focus on managers. If the manager has been proactive enough to be conservative, uh, professional manager I'm talking about, and if you believe the guy is talking sense or making sense of things, please continue to invest in that. Again, as I said, that individual stocks, stay away from the temptation of buying individual stocks. Go for a portfolio, go for mutual funds, and that's how you should be playing it out. So that way.
There's very one very nice question, which is how to behave in this market currently. I think it's from a distribution perspective, that how do we behave, you know, if we
So,
become, we are like all panic, right? You see a news channel, you will see 10 types of view, and most of them, going into negative. So how does one stay calm in this kind of
okay, so as I said, that if the war wasn't there, you would have seen India again growing this month. You would have seen a positive return from the markets as such. It's only because of the war that this has happened. I mean, war hasn't. India wasn't involved in that war. It's got impacted because of the global flows and stuff like that. Whenever this reverses, and you've seen that whenever a sound bite comes, a small sound bite about war abating and all that, you see a massive rebound happening in the market. I think that is the only comfort that you can take away. The hope is that this will continue, but anyway, that's just a hope. This will get over soon, but that's just a hope. But whenever that happens, do not back off. Don't think that the day this reversal happens will be the only time India will go up. After that, will be again a structural story playing out. So keep on it, remain there. And obviously, for the distributors, I think SIP is the best way to play this. This is the time when
SIP
you
or
want to
STP?
average.
STPs.
STP, sorry, STP
STPs.
is the
SIPs
best way
are
to go.
anyways going on.
Yeah,
Yeah.
or going on. And STP
There
is
is
the
no
only
point
way you
in
can.
stopping STIPs right now. Yeah.
Yeah, yeah, yeah.
We'll
That
be
is the.
publishing, for a distributor's perspective, we will be sharing a one small creative on that how two people's journey would have been different if they would have stopped their SIPs or paused their SIPs in these kind of panic situations, again restarted, how the, so we'll be publishing that very soon. But yeah, Dinshaw, sorry.
So anyway, as I was saying that STP is the way to go. Probably you can have a STP not for 5, 6 months, but you can have it for
Yeah.
at least 2 months or so, and then take a call beyond that. What do you want to do that as such? So that's where I'm coming from. There's one question about can we switch to debt funds? Definitely not. It's not the time to switch to debt funds. In fact, the debts, the yields may just tighten as such. So that will lead to the debt funds going off to give you negative returns because of the liquidity crisis, nothing else. So it's better
Because
to stay away from the debt
inflation
funds.
also, right? I think inflation
Constant.
is also building up, sort of.
Yeah, so basically, inflation also will build up because of the crude if
Yeah.
crude remains at these levels as such. So that way, so definitely not a time to switch to debt funds as such.
Can
So if you had asked me this question, by the way, someone's asking me, can we expect good returns this year? Right. So if you had asked me this question, say before the war started, right? Say on 27th of Feb, before the war came up, I would have told you that definitely you'll see healthy returns, healthy as in
we've been telling,
14,
yeah.
15% kind of returns. Obviously,
Yeah.
the small cap universe will offer you a higher return as compared to that. But today, if you ask me, I think all the returns will be back-ended. My feel is again, the caveat is that if the war gets over, say within this month, I don't see that 13, 14% getting impacted. I see that, in fact, getting compressed in a matter of 9 months instead of over 1 year, right? Because that's the amount of time that will be left. So maybe that is the kind of return, but everything lies on this, on the war getting over very fast. And again, once again, let me tell you that the problem is not the war happening. The problem is the region in which is happening, and the problem is the way it's impacting crude prices. And unfortunately, India being a large importer of crudes, that is where we're coming from.
There are questions on BAF, whether someone should shift to arbitrage. I think, you can come to our BAF because our BAF also does arbitrage, so it's a better, and there hasn't been that volatility. It is slightly high on equity, so it has taken that much of correction, but there is no so much of volatility. in our BAF, there was a question which I would like to answer, and our IT view, we have always been very vocal about. We have been talking about that. Private banks, Dinshaw, I mean, private banks, would you like
Yeah,
to?
okay. So I would take up both, in fact, private banks and IT sector also. By the way, private banks, it's no more 2.1 times book. It's close to 1.6, 1.7 times book for the whole sector per se. In the last few days, the correction has been pretty sharp. And you know the reasons for the correction. The correction was, initial correction was because people thought the PSUs were taking away the pie from the private sector. And the next set of corrections came with whatever happened in one of the largest banks in the country, when the chairman quit and didn't have a reason for quitting. But anyway, those clarifications came through the conference calls, which were very satisfied with, knowing that Keki Mystery is a very strong uh, person and he will not be standing for these kind of nonsenses. But anyway, so that will take its own course as such. We believe that the onslaught from the PSUs was obviously expected because they leverage their balance sheets by 12, 13 times. The private sector, being more conservative, does it 6 to 7 times. And that is why the private sector has these healthy ROEs and ROCEs on their books, which are almost double that of the public sector banks. The public sector banks, with the high leveraging, have a very low ROC. And obviously, you can imagine when the interest rates are coming off, they have that leeway to play that game. The public sector has that leeway to play the game because the NIMs are now getting impacted for both the private and the public, and they can do an onslaught because of cheaper borrowing costs as such. But that game can go for a toss once the interest rates stabilize, and plus one strong account, and you can blow up the bank, right? With those kind of leverages. That is why the private sector always is very conservative. The private sector can overcome that by purely by just leveraging the book by one more time, right? And that will see their ROEs maybe coming off, but they'll see a huge onslaught in terms of their NIMs per se, right? They don't want to do that right now. Obviously, this game will play out its own course, but our feel is that private sector will come out much more stronger from this thing than the public sector banks. And frankly, I mean, the public sector banks are not as consumer focused. You walk into a PSB branch and you walk into a private sector branch, you'll see the difference. And that's why we expect the consumer to be more keen towards the private sector than the public sector. So that's on that. On IT front, our call has been perfect. We've said avoid IT. Even today, we're saying avoid IT. By the way, in our long short fund, we used to short IT. But today, we're not shorting IT because given that the P's are close to 15, 13, 14, 15 in certain cases, we are staying away from IT per se. Plus, please understand, Accenture, which came out with numbers yesterday, they also called out that whatever growth they've seen is through market share gains. They haven't seen the demand moving up per se. So it's obvious that when they are seeing Accenture as a US-based company, though the manpower sits in India, same as the case with Cognizant, the fact is that when they say market share gains at the expense of Indian IT players, they're seeing a lot of competition in the market. And obviously, AI is a big portion of that as such. So that's why we are avoiding IT even today, even at these cheap value. By the way, Accenture is quoting at 13 Ps. Infosys quotes at 15 Ps. And Accenture has much greater growth rate than Infosys has as such. So you can imagine where the money will flow, if at all it wants to flow into IT per se. So we are avoiding IT today. We're not too keen on IT even now.
So there are some questions on change in BAF taxation. There is no change in BAF taxation. It remains the same. And what else? There is a small cap view of Helios. We have shared a view. We are fairly, we continue to be the same what when we raised money. It's unfortunate that we had this March and Feb. That's unfortunate, but we stay put on our view on small cap. In fact, Dinshaw did discuss about that. So there's nothing to be worried on that. And in fact, one want to buy, they can continue buy using STPs and SIPs. So I think, in terms of consistency, there is a question. In fact, we've been fairly consistent. If you pull out a roll return of flexi cap, which is the longest one, 85 to 89% time it has been in Q1. So I think that talks about the consistency. And our endeavor is always to be consistent. So, be rest assured that that our investment team is on it. And yeah, and before we conclude the call, Dinshaw, let's say if everything goes as we plan, that life settles back again, is there a change in any sector from a medium to long term view? Any change uh,
So
in the
we okay.
leaders who will lead? Yeah.
Yeah, so basically, I think the oil marketing companies, I think they'll see a problem going forward, and that's why OMCs is something which can be avoided today. We don't expect crude to come back to those $60 levels.
Ah, yeah,
We
yeah.
think, yeah, it'll
Yes.
stabilize at 75, 80 odd dollars, and at those levels, obviously, these companies won't make too much money. In fact, they'll be eating into their old profits as such. So that's why we think that's a void as such. So purely avoidable. Secondly, I don't think we've churned too much on our portfolio per se. The fact is that we continue to remain quite gung ho. And one thing that will come out of this whole thing is that all the countries will look at two things. One is the storage capacities for their crude. So you can imagine which all players will play out here. Energy security, if you will,
Yeah,
as they put
energy
it as such.
security is.
So that will be one major fallout of this. The second major fallout will be defense. I think each and every country will look at strengthening their defenses as such,
We will
and
learn
that's
from
what will play out going forward as such. So I think these
very
are the two, three
important.
areas which one
Key,
should look
key
out for.
tailwind things, if you have to talk about. I think energy security and defense
Yeah,
becomes a key integral part of portfolio.
right.
Then I think no more questions there. Thank you very much for your time. Thank you very much, partners, for taking out time. I understand it's very difficult to manage on ground, but as you mentioned that we have to show the trait of being firm and manage investors, and even because we have access to information, right? You all talk to us and many other managers. You have access to information, but the investor doesn't have much of an access, or they have access to a very loud media which keeps talking and instilling fear a lot. So we need to manage and hold investors, and I think we hope and pray that things become good. So with that, thank you very much once again. Thank you, Dinshaw, once again, and everyone. And we see you around next time when we meet. So we shall let you know on that, and we look forward to your participation next time. Thank you so much.
Thank you, guys. Have a nice weekend.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.